I need you to understand something I have only seen 3 times in my career. The signal is not a warning anymore. It is a confirmation. And every time this confirmation has appeared, the market that followed was not a correction. It was something the models said could not happen. That is the part I need you to hear clearly tonight. The last time I saw conditions line up like this, I called my closest advisors into a room, closed the door, and told them to prepare for something the textbook said could not happen. That was the autumn of 2007. The yield curve had inverted. Commercial paper was freezing. The Federal Reserve was still calling the problem contained. 18 months later, the entire global financial system nearly stopped functioning. Lehman was gone. Bear was gone. Money market funds broke the buck. The plumbing of capitalism froze. I sat there watching it unfold exactly the way the signal had described it in that closed room. I am calling that meeting again, and this time I am opening the door because the signal just confirmed the yield curve has uninverted. Short-term rates are now falling faster than long-term rates. That flip is the mechanical confirmation that a credit event is no longer a possibility but a probability. And if you hold gold or silver right now, if you have followed the inflation playbook, if you have watched the debt curve go vertical and the central banks accumulate, you are probably staring at a red screen and wondering why the metals are not behaving the way the narrative promised. Silver is down more than 40% from its high. Gold has pulled back double digits. Bombs are falling. Central banks are buying. Debt is exploding. And your position is bleeding. The quiet voice in the back of your mind is asking whether you got the trade wrong. Let me ask you directly. Do you understand the actual mechanism behind what you are seeing? Because if you do not, you will sell at the exact moment the mechanism is loading the next leg higher. I am not going to give you opinion. I am going to give you the mechanical sequence that has repeated after every major credit event since 1973 without exception. By the end of this video, you will understand the exact phase pattern that follows this confirmation. You will understand why gold and silver must weaken first before they move violently higher. You will understand the 3 structural forces that make this cycle larger than 2008 or 2020. And you will have the 2 specific indicators that will tell you when the real move begins. Once you see the sequence, you cannot unsee it. Here is the mechanism. A shock hits. Energy prices rise. Inflation expectations reprice higher. The market removes any hope of Federal Reserve rate cuts. Bond yields stay elevated. The 10-year Treasury is sitting at 4.39% right now. That yield is the opportunity cost of holding an asset that pays nothing. Capital rotates out of gold and silver and into treasuries. At the same time, fear drives a flight to the dollar. The dollar index strengthens. Because gold and silver are priced in dollars, a stronger dollar mechanically pushes their prices lower. 3 headwinds, all caused by the same event that should be bullish. That is why your screen is red while the world burns. This is not a contradiction. This is mechanical, but this suppression is temporary. It is the first phase of the sequence. I have watched it resolve the same way every single time. Go back to 1973, OPEC embargo, oil quadruples. Gold gets hit initially, then rises over 200-300% by January 1980. Go to 1979, Iranian Revolution, gold flatlines, then rallies 89% in 12 months. Go to September 2001, towers fall. Gold drifts, then begins a decade-long run from $250 to over $1,800. Go to February 2022. Russia invades Ukraine, gold pulls back, then breaks to $1,000 for the first time. Every single time the pattern is identical. The initial shock suppresses the metals. The monetary response that follows lifts them. The re-rating that completes the cycle makes the old prices look impossible. Silver behaves differently. Silver lags longer. Silver frustrates its holders more severely, and then silver overtakes gold violently. In the 1970s cycle, gold rose 24 times. Silver rose more than 30 times. In the 2008 to 2011 cycle, gold roughly tripled off its low. Silver rose over 400% in the final 2 years alone. The lag is not random. It is the transfer mechanism, the people who cannot stand the lag sell to the people who understand it. That brings me to the 3 forces converging right now that make this cycle different in degree. Fourth one is the weaponization of the dollar. In February 2022, $300 billion of Russian central bank reserves were frozen with a keystroke. Every finance ministry on earth received the same message. It's not our job. If it can happen to Russia, it can happen to anyone. The response has been the most sustained central bank accumulation of physical gold in modern history. China has added every month for over 2 years, Russia for more than a decade, Poland, Hungary, India, Turkey, Singapore. The people who print paper currency are buying the asset paper currency was supposed to replace. That is not a hedge. That is a permanent shift. Force 2 is the debt spiral. The United States carries over $39 trillion in federal debt. Interest expense alone is running at $1.3 trillion per year. That is more than the defense budget. Roughly $9 trillion of debt must be refinanced in the next 2 years at 4 to 5%, not zero. The arithmetic does not permit the Federal Reserve to do what Paul Volcker did in 1980. The only exit is to inflate the real value of the debt away. When that realization becomes consensus, gold and silver will not rise gradually. They will gap. Force 3 is silver's unique position. Silver is the only asset that is simultaneously a monetary safe haven and a critical industrial input. Global mine supply is roughly 830 million ounces per year and has been flat for a decade. 70% of that supply is a byproduct of copper, lead, and zinc mining. Supply cannot respond to price. China controls approximately 60% of global refining capacity and has restricted exports. Solar manufacturing alone consumed over 200 million ounces last year. Projections show solar demand moving toward 400 million ounces annually by 2030. We are in the 5th consecutive year of a structural physical silver supply deficit. When the monetary bid returns on top of industrial demand, that never stopped. Silver does not adjust gradually. It gaps. Now I need you to understand the 4-phase recovery pattern that follows this confirmation. Phase 1 is the panic. It lasts 1 to 4 weeks. Sharp selling. Forced liquidation. Margin calls. Headlines declare the metals trade dead. This is where we are now. This is the phase that tests whether you understand the sequence or whether you react to price. Phase 2 is absorption. It typically runs from month 2 to month 3. Retail capitulates and sells the bottom. Financial media writes obituaries. Institutions accumulate quietly off the headlines. We are transitioning into this phase. Phase 3 is the structural bid. It runs from roughly month 4 to month 18. Central banks, sovereign wealth funds, and large institutions accumulate methodically. Price grinds higher while nobody celebrates. Phase 4 is new all-time highs. It begins around month 12 and runs for years. This is when the public finally arrives. Write this down. We are in late phase 1, moving into phase 2. The transfer is loading right now. So how will you know when phase 3 begins? Not from war headlines, not from inflation prints. 2 indicators. The dollar index breaking and holding below 97. The 10-year Treasury yield breaking and holding below 3.5%. When both trip, the mechanical suppression is exhausted. Everything else is noise. Let me describe the morning I told you about. September 16th, 2008. The day after Lehman filed for bankruptcy. I was on a trading floor in New York. Every screen was red, every asset class. Gold was down, silver was down. A young trader turned to me, nearly in tears, and asked why his insurance was failing during the fire. I told him, insurance does not pay while the building burns, it pays after. He held. 3 years later, his silver position had multiplied several times over, but only because he did not sell in October 2008 when the headlines were loudest. Most people did. Most people always do. That is the pattern. The crash confirms. The panic sells everything, including the hedge. The response floods the system with liquidity. The realization that liquidity creation debases currency drives metals to new highs. Every single time. Now I need you to understand why this cycle is larger than 2008 or 2020. In 2008, U.S. federal debt was approximately $10 trillion. Today it is over $39 trillion. In 2008, the Federal Reserve's balance sheet was under $1 trillion. Today it is structurally larger. The monetary response required to stabilize the next event will need to be larger, faster, and more aggressive than anything we have seen before. That means the eventual move in gold and silver when it comes, could be faster and larger than either of the previous two cycles. There are two types of investors watching this right now. The first type sees the red screen and concludes the trade is broken. They sell. They will buy back at much higher prices after the Federal Reserve responds. They fund the wealth of the second type. The second type understands the four-phase sequence. They understand that a confirmed crash signal means prepare for temporary weakness before a historically larger move higher. They watch the dollar index and the 10-year yield. They size positions so phase 1 volatility does not force a phase 3 mistake. They hold through the fire because they know when the claim gets paid. I have watched both types for 40 years. The first group panics at the same point in the cycle every single time. The second group profits from that panic every single time. The mechanism does not change. Only the people experiencing it change. Think back to the beginning. I told you about a meeting in 2007 where I closed the door. Nobody listened. Tonight I opened the door. I showed you the mechanism. I showed you the 50-year pattern. I showed you the three forces. I showed you the four phases. I gave you the two indicators. I told you the Hunt brothers story. I described that September morning. What you do with this is your decision. But you can no longer say you did not understand the sequence. You cannot unsee this. Watch the dollar. Watch the yield. Size your positions for volatility. And when phase 3 confirms, remember that the people who profit are never the ones who sold during the fire. They are the ones who understood that the insurance policy pays after the smoke clears, not while the building is still burning.